How you doing? I'm Alex Jones. Good. Can you just repeat? You're saying this is private property? Sure, go ahead.
This is the property of the Federal Reserve right here.
Private though. It's not federal, right?
Yeah, private property. Okay. I need you to go back to the public street.
I think, you know what? It is private property. I think you're right. We will get off. You're absolutely right. Let me just ask you this one question. And I'm going to ask everybody to move off the private property of the Federal Reserve. Doesn't this look like a post office? And it's got federal seals on it? It says Federal Reserve? It's like counterfeiting or something. It'd be like if people opened up a...
No, the Fed doesn't counterfeit, do they?
I think that's something police ought to investigate.
Yeah, really.
I mean, just down the road. Doesn't this kind of look weird? It's a federal building, but it's not federal.
I mentioned that to them. They said that there was
I'm sorry.
nobody
Not a
inside
federal
it, Alex.
It's not a federal building. 10 years ago, cops would laugh at me about that. I'm excited you know.
However, you're welcome to call our public affairs or call our head office in Dallas and speak with that.
No, sir, you've been super nice. You're right. Some people thought it was like a park because it looked like a post office. You're right. This is private property. We better get off. Hey guys, well they do get our tax money and they do control everything.
Enslave us!
I mean, sure they are the slave masters, but see that you heard the police officer. He's right. This is private property, so we want our private property. Now it's private property of a mafia, of a criminal cartel, but nevertheless it's their private property for now, and until they're indicted and imprisoned, we won't. And until we finally get the audit and the Congress raids all the material, we're gonna respect their private property until then. So let's get off the private property of the Federal Reserve right now. Come on, everybody. Come on, let's go.
Good. Just ask you to stay back off our side of the property, please.
Okay. Is this a private property or is this publicly owned? Okay.
Okay. Can we ask you a few questions?
No. But
No?
you can step back onto that side of the gate, please.
Okay.
Oh well. If
We're safe. We're safe on the sidewalk right there, though, right? Okay.
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 Have a great day.
All right. Thanks. Yep.
What's that?
You go through public affairs.
No, I was just getting some interior shots
No, you need to go through public affairs for you to videotape or take pictures
of any federal building.
of any federal building.
Because I was just at the Academy of Sciences.
I don't care, Captain. This is Federal Reserve. For you to take pictures or videotape, you just have to call public affairs. They set it up. You have a meeting. They tell you what time to come out and take pictures. You take pictures all day long.
So I can't stand on the public sidewalk and take
You can go across the street if you like, but they still gonna come over there and ask you questions if you stay too long.
So where am I allowed to shoot from?
You can't take pictures of a federal building. Period.
And not even if I was a tourist, I couldn't even take a picture of the Capitol.
If you was a tourist and you went by and you snapped a picture, they're not going to snatch your camera. But if you come up with something like that, they're going to approach you and they're going to ask you what you're doing. They're going to ask you for ID, all that good stuff.
Huh.
Okay?
What if I was wearing like a press badge?
Now, if you did that, they're going to ask you who's your contact person, because then you should have contacted Public Affairs.
The Fed, Public Affairs, or just like...
Public Affairs for the Federal Reserve.
So for every building I need to contact that
Yes,
Public
sir.
Affairs person?
Yes, sir.
You guys can leave right now. If you're not going to cooperate, I'm just asking questions.
This is public property.
No, it's not actually.
Whose property is this?
So we're just asking you some questions. If you can't cooperate, you need to leave.
Okay, but first of all, whose property is this?
Liberty Memorial.
Okay.
You're not doing anything
And you're
wrong,
police
but
officers or
some
security officers?
There's some protection officers here.
Uh-huh.
And because you're not cooperating, you need to go ahead and leave. I asked you a simple question. You're not doing anything wrong. You're videotaping.
That's
So-
right.
Right.
Yeah. Well, that's all we're just here to
Okay,
videotape, so.
thank you, and I appreciate it.
Okay. Fine.
Thank you. Yes.
Come on, guys, let's go.
Guys, let's go.
Why do I have to leave?
Because you're with them.
Where's the property end?
Outside.
Park. Well, if he gave his name, then he doesn't have to leave.
He did give his name, but
Okay.
it's kind of guilt by association. You guys can go ahead and go.
What is guilt by association?
Sir, we're not going to answer any more
Leave.
questions. You can go to jail or you can leave.
Are you a police officer, sir?
We've
We do have arrest powers. Do you want to go to jail?
Am I under arrest?
No, you're not under arrest. Not yet. You need to leave.
You're encroaching on our First Amendment right.
No, we are not.
Why not? Is this public property? We have a right.
Go ahead and go.
The United States government decides it needs some money, so it calls up the Federal Reserve and requests, say, $10 billion. The Fed replies, saying, sure, we'll buy $10 billion in government bonds from you. So the government takes some pieces of paper, paints some official-looking designs on them, and calls them Treasury bonds. Then it puts a value on these bonds to the sum of $10 billion and sends them over to the Fed. In turn, the people at the Fed draw up a bunch of impressive pieces of paper themselves, only this time calling them Federal Reserve notes, also designating a value of $10 billion to the set. The Fed then takes these notes and trades them for the bonds. Once this exchange is complete, the government then takes the $10 billion in Federal Reserve notes and deposits it into a bank account. And upon this deposit, the paper notes officially become legal tender money, adding $10 billion to the U.S. money supply. And there it is. $10 billion in new money has been created. Of course, this example is a generalization, for, in reality, this transaction would occur electronically, with no paper used at all. In fact, only 3% of the U.S. money supply exists in physical currency. The other 97% essentially exists in computers alone. Now, government bonds are, by design, instruments of debt, and when the Fed purchases these bonds, with money it essentially created out of thin air, the government is actually promising to pay back that money to the Fed. In other words, the money was created out of debt. This mind-numbing paradox of how money or value can be created out of debt or a liability will become more clear as we further this exercise. So, the exchange has been made and now $10 billion sits in a commercial bank account. Here's where it gets really interesting. For as based on the fractional reserve practice, that $10 billion deposit instantly becomes part of the bank's reserves, just as all deposits do. And regarding reserve requirements, as stated in modern money mechanics, a bank must maintain legally required reserves equal to a prescribed percentage of its deposits. It then quantifies this by stating, under current regulations, the reserve requirement against most transaction accounts is 10%. This means that with a $10 billion deposit, 10% or $1 billion is held as the required reserve, while the other $9 billion is considered an excessive reserve and can be used as the basis for new loans. Now, it is logical to assume that this $9 billion is literally coming out of the existing $10 billion deposit. However, this is actually not the case. What really happens is that the $9 billion is simply created out of thin air on top of the existing $10 billion deposit. This is how the money supply is expanded. As stated in modern money mechanics, of course they, the banks, do not really pay out loans from the money they receive as deposits. If they did this, no additional money would be created. What they do when they make loans is to accept promissory notes, loan contracts, in exchange for credits, money, to the borrower's transaction accounts. In other words, the $9 billion can be created out of nothing simply because there is a demand for such a loan and that there is a $10 billion deposit to satisfy the reserve requirements. Now, let's assume that somebody walks into this bank and borrows the newly available $9 billion. They will then most likely take that money and deposit it into their own bank account. The process then repeats, for that deposit becomes part of the bank's reserves. 10% is isolated, and in turn 90% of the $9 billion, or $8.1 billion, is now available as newly created money for more loans. And, of course, that 8.1 can be loaned out and redeposited, creating an additional 7.2 billion, to 6.5 billion, to 5.9 billion, etc. This deposit money creation loan cycle can technically go on to infinity. The average mathematical result is that about $90 billion can be created on top of the original $10 billion. In other words, for every deposit that ever occurs in the banking system, about 9 times that amount can be created out of thin air.
Money jitters Ask the obliging Bank of America for a jar of soothing instant money, M-O-N-E-Y, in the form of a convenient personal loan.
So, now that we understand how money is created by this fractional reserve banking system, a logical yet elusive question might come to mind. What is actually giving this newly created money value? The answer? The money that already exists. The new money essentially steals value from the existing money supply. For the total pool of money is being increased irrespective to demand for goods and services. And as supply and demand finds equilibrium, prices rise, diminishing the purchasing power of each individual dollar. This is generally referred to as inflation, and inflation is essentially a hidden tax on the public.
What is the advice that you generally get? And that is inflate the currency. They don't say debase the currency. They don't say devalue the currency. They don't say cheat the people who are saved. They say lower the interest rates. The real deception is when we distort the value of money. When we create money out of thin air, we have no savings, and yet there's so-called capital. So my question boils down to this. How in the world can we expect to solve the problems of inflation, that is, the increase in the supply of money, with more inflation?
Of course, it can't. The fractional reserve system of monetary expansion is inherently inflationary. For the act of expanding the money supply, without there being a proportional expansion of goods and services in the economy, will always debase a currency. In fact, a quick glance at the historical values of the US dollar versus the money supply reflects this point definitively, for the inverse relationship is obvious. $1 in 1913 required $21.60 in 2007 to match value. That is a 96% devaluation since the Federal Reserve came into existence. Now, if this reality of inherent and perpetual inflation seems absurd and economically self-defeating, hold that thought, for absurdity is an understatement in regard to how our financial system really operates. For in our financial system, money is debt. And debt is money. Here is a chart of the U.S. money supply from 1950 to 2006. Here is a chart of the U.S. national debt for the same period. How interesting it is that the trends are virtually the same. For the more money there is, the more debt there is. The more debt there is, the more money there is. To put it a different way, every single dollar in your wallet is owed to somebody by somebody. For remember, the only way the money can come into existence is from loans. Therefore, if everyone in the country were able to pay off all debts, including the government, there would not be $1 in circulation. In fact, the last time in American history the national debt was completely paid off was in 1835 after President Andrew Jackson shut down the central bank that preceded the Federal Reserve. In fact, Jackson's entire political platform essentially revolved around his commitment to shut down the central bank, stating at one point, "The bold efforts the present bank has made to control the government are but premonitions of the fate that awaits the American people should they be deluded into a perpetuation of this institution or the establishment of another like it." Unfortunately, his message was short-lived, and the international bankers succeeded to install another central bank in 1913, the Federal Reserve. And as long as this institution exists, perpetual debt is guaranteed.